Coming up in today's video, stocks are under pressure, and this is most likely due to the fact that Trump says China has totally violated the agreement with the US on tariffs. Here's a quote here: "China, perhaps not surprisingly to some, has totally violated its agreement with the US. So much for being Mr. Nice Guy," Trump said in a post on his Truth Social platform. And according to U.S. Treasury Scott Bessent, the U.S. trade talks with China were a bit stalled, and getting a deal over the finish line will likely need the direct involvement of President Donald Trump and Chinese President Xi Jinping. In other news, Trump tariffs are reinstated by the appeals court for now. This was a big headline yesterday, and by the afternoon, our video was already outdated. But it looks like for now, the Trump tariffs are back on. Here's an overview of how things are looking so far today. The S&P 500 was down, followed by the NASDAQ and other major indices, now trading sideways here this morning, at least at the time of recording. Gold popped higher in all of this trauma. Bitcoin fell a little bit from its recent all-time highs, and the dollar index also fell as well. Oil, meanwhile, is back down to 61. Let's also take a look at gold to see what the current development here is. What we can see is price action continues to be respecting this downward channel, but there are some forces that are holding prices from moving much lower, at least at the time of recording this. With all of this tariff uncertainty coming back into the picture, we know what that did back in April. When tariffs seemed uncertain and they were coming in hot and heavy, that caused gold to rip higher. But since then, we've mostly had a lot of positive negotiations. But with the recent developments, the question is gold going to actually break out to new highs? Well, I'll give you my opinion on this. I would not be surprised to see gold make a run back to retest these all-time highs, but I would be surprised unless we get a major catalyst in the form of complete breakdowns in trade dynamics, or Russia, completely goes back into war mode with Ukraine, something like that. That's what it would take to get prices to actually dramatically break to fresh all-time highs for gold. So in my personal opinion, based on the US economic heat map, which I can show you now, which is giving the US dollar a sort of neutral reading, we have some positives, some negatives. That tells me that gold could move higher, but I think it has limited upside as well as limited downside. I post regular updates on the US dollar, gold, and latest economic data in our free to join Telegram channel. If you haven't joined it already, make sure to use the link in the description down below to join the Telegram. I oftentimes mark up charts on gold, indices, the dollar, and more. And speaking of the US dollar being mixed, I think price action is still sort of in a no man's land type of environment. We saw a little bit of a spike higher here, but now prices have come back down. And this is largely dependent on, of course, the trade dynamics, but also next week we get the NFP report. And in the last two jobs reports, we've had stronger than expected readings. Will we get another one coming in next week? I'll give you my take on this. If you get the NFP report to miss expectations, it is going to pose some serious risk to this market, specifically the US dollar, I think could drop pretty hard. You already have uncertainties around tariffs, which challenge the US dollar kind of centralism. And so what we definitely do not want to see happen is for the economic data of the United States to materially weaken in the form of the big one, which is NFP. If we miss job expectations, I think you lose a lot of ground on the US dollar, and it actually could be a catalyst that would take us to fresh lows. And in that environment, I probably would actually get bullish on gold, because if jobs numbers materially weaken, that is going to dramatically change the overall landscape for the state of the US economy. And a concerning component to this is that unemployment claims that came in yesterday were actually weaker than expected, not by a tremendous amount, but it is something to keep tabs on here. Is the job market weakening? And if so, would that mean the Fed needs to step in? However, can the Fed step in if tariff uncertainty is right around the corner, which could cause price increases? And this week we got Fed meeting minutes, which showed elevated uncertainty about the economic outlook. Officials from the Federal Reserve indicated during their most recent meeting that they might encounter difficult trade-offs in the upcoming months. Let me translate this. Basically, if the jobs market starts deteriorating, but at the same time inflation starts rising, the Fed is in a very difficult position. Because let me ask you to think about this mentally if you are challenging yourself fundamental analysis wise. What do you do if you're the Fed if the jobs market is cooling, so you want to cut interest rates, but inflation is rising, so you want to raise interest rates or hold them steady? what do you do? With rising inflations occurring alongside increasing unemployment. This perspective was supported by projections from Fed staff that highlighted heightened risks of a recession as revealed in the newly released minutes from the May 6 to 7 session. And this line right here is what I really wanted to show you guys. Participants noted that a durable shift in such correlations or a diminution, I don't know how to say that, of the perceived safe haven status of U.S. assets could have lasting implications for the economy. And this, to me, from the Fed acknowledging this, the de-dollarization concerns is a very real thing for Fed committee members. And so next week's NFP report is a really important one. And I also want to let you guys know, if you're looking to keep up to date with all of this economic data in one centralized place, the software that I use in my videos is called the Edge Finder. It's a tool that my team and I have built to help traders scan tons of market data all in one place. And if you'd like to explore the Edge Finder in its full features, you can head over to a1trading.com, hover under Edge Finder, and you can view the tutorials, set up a free training call, or get access if you'd like to. If you go to a1trading.com/edgefinder, you can also request a 30-day trial, which costs $199, or you can request a free training call to connect with someone on my team. In recent years, we've also seen some serious scrutiny about U.S. national debt. And with the U.S. national debt clock reaching or getting close to $37 trillion, it's no question why there is a little bit of uncertainty around lending money to the US government. Now, all of this is relatively okay as long as the economy holds up. But if the US economy starts to enter into a serious recession while having a massive debt to GDP ratio already, we could see some serious problems. And no one knows this better than the bond market itself. Despite inflation falling in recent times, we still see the US 10-year yield at 4.42%. What this is suggesting, or could be suggesting, is that bond investors are saying, we're not buying your bonds unless you give us more yield on the bonds that we're buying. In fact, a very concerning component in all of this is that the Federal Reserve started cutting back in September of 2024, and look what happened to yields since then. When the Fed is expected to cut interest rates and inflation is expected to come down, yields tend to fall. But what we actually saw is as soon as the Fed actually started cutting rates, the bond market priced bonds lower, increasing the yields. Why would it do that? Well, one pretty grim or dire situation is that bond investors are saying the US trustability factor, which recently, by the way, got downgraded by Moody's, which happened May 16th, 2025. Moody's rating downgraded the United States credit rating from AAA to AA1, just showing that US national debt is something that investors are thinking twice about giving over their money to the US government. I don't know about you, but I too would be a little cautious about lending money to a friend who is spending way beyond their means. And so to me, this is a big risk to the economy, because if this starts to dramatically rise from here off of higher than expected inflation prints, it could seriously cause some trouble for things. While the yields being where they are currently, I don't think are necessarily disastrous. If they dramatically rise, that could seriously threaten the stock market. Because remember that this is the rate at which the US government has to borrow money. Right? So when the Fed prints money and there's a borrowing rate, if that borrowing rate goes up, it makes the national debt even harder to pay off. When the national debt, when the yields go down dramatically, it makes it easier for the Fed to borrow money and for us to pay back our loans, because again, we're borrowing at a lower rate. So why doesn't the Fed just cut interest rates dramatically? Why are they being so difficult with all this? Well, the reason that the Fed can't just simply cut interest rates and save the day very easily is because inflation is a very serious matter. In fact, throughout world history, inflation is what many times is called the empire destroyer. It can really seriously destroy an economy if inflation gets out of hand, because again, it deteriorates the spending ability of the consumers, the economy goes into a recession, and all that sort of ugly stuff can occur. So the Fed is very sensitive about that. And while we are getting closer to inflation reaching that 2% target, they're kind of on a wait and see standpoint with all of this tariff stuff. Because if tariffs do cause inflation to start rising again, then the Fed has a problem to deal with. And if they cut interest rates into that environment and tariffs also create inflation, rate cuts could bolster inflation, and so too could tariffs at the same time. And we could get right back into the same dilemma that we were in 2021 and 2022. Here's a look at oil prices, which are continuing to stay kind of muted for the most part, around $60 per barrel. Remember that inflation can also be negatively impacted by rising oil prices and positively impacted by falling oil prices. So we'll see what happens here. Always worth keeping an eye on oil prices. And today's video is sponsored by Oanda. If you're a US Forex trader looking for a better brokerage, this is my personal pick. I've used Oanda for many years, and I find them to be a reputable and great brokerage for retail traders looking to trade FX specifically. Currently, they offer some really generous sign-on bonuses, which you can find out more information about in the description down below of this video. Check out Oanda. Like I said, I've used them for years, and I'm a big fan of everything that they're doing. They offer some really great tools, and they have some exciting announcements coming that I can't give you any information about at this time, but just know Oanda is innovative. They're building some great stuff, and they offer some really generous welcome bonuses to their clients. You can explore them, like I said, in the description down below. In today's podcast episode on the Market Insights podcast with Johnny Hart, we had an interesting conversation I think you might want to stick around for. If you'd like to check out the full podcast, the link will be in the description below.
The latest news coming out of the US Treasury, and this according to Treasury Secretary Scott Bessent, is that trade talks between the US and China are quote unquote a bit stalled. So his comment comes less than 3 weeks after that temporary trade truce was agreed between China and the US, with both agreeing to reduce those tit-for-tat tariffs. So market reaction to that, Nick, possibly a bit disappointed, or is there more to come anyway?
Yeah, I think what is fair to say is a lot of the recent rally in the stock market and some stabilization, if you will, in the US dollar recently has been off the idea that US and China relations had kind of paused. Like things were basically at a point where, okay, we're going to come back to this, we're going to negotiate, we're going to find a deal. That was where we left things off. Since then, we've seen a little bit of a jab here recently from Trump. I don't have the exact specifics, but there was some limitations on, chip manufacturing related products being sent to China. That was a bit of a piece that came out in recent days. A little bit of a jab from the United States side there, and then at the same time, we've now seen, as you mentioned, the Scott Bessent comments. Trump sort of did it in his own way, obviously a little bit more bombastic, right? Saying that, was anybody surprised that China's breaking our trade deals? I'm paraphrasing dramatically here, but that was kind of the stance that Trump is taking on that. And the market obviously does not like that, right? The market does not like any time that there is a breakdown in the relations, some frustrations there. However, we've seen this story so many times recently, Johnny. Last Friday, and this is almost a weekly occurrence, where Trump kind of throws a fit about a particular dynamic between trade relations with another country, and then shortly after dials it back. Oh, we had a constructive call. So is that theme going to keep repeating? We'll have to see. The dollar index did lose some ground here on this, but has bounced back since. So I wonder if the market's kind of getting used to this at this point. Also, Scott Bessent suggested that serious negotiation progress would probably require the leaders of these two nations to actually discuss face-to-face or at least call-to-call, basically calling for further action on both sides in order to get something done.
It is like a weird kind of dance that's going on between the Trump administration and a variety of countries and blocs, more specifically China and the EU. But, the old word that comes up again and again, we mentioned it every time, I think recently, of uncertainty. This is what puts paid to that uncertainty, and this is what markets don't like. And as you said, how long is this going to continue for before we actually get some sort of nail on agreement? I mean, perhaps people could take a leaf out of the UK-US agreement and just sign it off. I know things are a lot more simple between the UK and the US because the export-import balance is fairly nondescript. But having said that, all this uncertainty, including the court case which goes on, is going to be tricky for markets because you just can't make long-term plans, can you? If you don't know what the tariffs are going to be. I mean, there are lots of exporters and importers out there who have to keep changing what they do as an expensive business, changing the tariff, changing the paperwork, the admin. It's not a good place to be in if you're one of those guys who are sending, for instance, from the EU. What do you charge? What does the US charge? It's a tricky one, and I can't see an end to it in the short term at the moment.
Yeah, not to mention, I mean, think about, to your example, if you're in the EU and you're in auto manufacturing and auto sales, your margins are not ginormous to begin with. So these dynamic changes in tariffs and trade, I mean, it is a very sensitive topic. You're not talking about a Microsoft with a 30+% margin on their business. You're talking about much tighter margins in the auto world. So yeah, no, it is a hard position to be in if you're someone who has to make business decisions.
I hope that video was helpful to you, and I also wanted to make sure to share our Telegram channel with you. Every day we are posting up chart markups and analysis and in-depth breakdowns of what's going on both fundamentally and technically in the markets. We also drop bonus videos in the Telegram channel, so don't miss out. Come join our Telegram channel. The link is in the description down below. Have a great rest of your day.